bright sunny afternoon.
Harvey, I'm right here.
I'm David Bloom, and I have the profound pleasure to welcome you to Point Angel's June Investor Day. And I'm also thrilled to see so many new faces that we picked up from last month's Portfolio Day event. Welcome, new folks. If you see a face that you haven't seen before, go up to them, accost them, make them feel welcome. I have a very short clicker. Thank you to give to Taft Law. Taft is has a big office in Southfield, Michigan, and in 6 other states and the District of Columbia. And they have made a commitment to Michigan's innovation ecosystem by sponsoring this group. I also want to make you aware of a couple of opportunities before I give you a little homily. There's on June 5th, US Venture, which is a consortium of different accelerators, this is their sustainability accelerator, is taking its roadshow to Detroit. So 5 of their accelerator startups, including our own Portco Electric Fish, are going to be here on June 5th. And they're booking 90-minute blocks to meet with these 5 companies. And the meetings will be face-to-face. Their office is on Woodward, just off Grand Circus. So they're all clean tech, energy, infrastructure portfolio companies from US Venture. If that is interesting to you, I would love to have a Point Angel there, because I'm going to be out of town. So come find me or raise your hand right now, and I will write it down and give you the details. Who wants to go see the US Venture Sustainability Accelerator Roadshow? Oh boy. Okay. we have a winner. All right, and then second, Invest 360. This is the program that Ann Arbor Spark puts on in the fall. Needs judges. A judge for Invest 360 will look at one of 3 different sectors, either their IT technology sector, their life science sector, or their mobility sector. And the criteria are different for every one of them. Now, this is kind of informative to me. If you're applying for this program and you're in IT or technology, they want you to have a minimum viable product and customer revenue. That's a pretty high bar for the IT guys. If you're in mobility, though, if you got an MVP and a beta, you're good. And if you're in life science, if you're in trials, because nobody has revenue, you're good. So this is, the books will go out on June 23rd. It's all online. And for the next 2 weeks, from June 23rd to July 7th, you'll review 5 or 6 companies. You'll get an executive summary and financials. So that's the Invest 360 judging. Let's not always see the same hands, Darby. Who's interested in who's interested in that one? Okay, Bill? Sorry?
I'm already doing it.
You're already doing it, great. Joe, Jimmy, Ben, Jimin? Oh, Dan, yeah, you're in for all. All right, thank you very much. All right, so how do we work? We are all accredited investors here. If you're not an accredited investor, you're presenting. If you're neither of the above, you're a sponsor. Otherwise, you're in the wrong room. And our DEI is deal flow, engagement, and integrity. We want to have really good deal flow, because really good deal flow is the foundation of a club that you actually want to be a member of. Engagement is what makes the club happen. If we're not doing deals, then why are we here? And integrity, let's talk for a minute about integrity. Integrity means that we're here for the purpose of investing and growing a startup, and through the quantity of deals that we do, a startup ecosystem. We're not poaching, we're not competing, we're certainly not cramming down these guys that we want to succeed. I was just talking with an angel investor right before this meeting. We go out of our way, it's called angel added value, to help them succeed. There's stuff that they don't know how to do. And maybe we do, and we help them with that. There's stuff that they really shouldn't be doing because they're no good at it. Good, we'll find somebody who does that. And it's a better use of our angel expertise than giving them angel capital to go and squander on something that is not going to be as effective. So that's our ethos, is angel added value. We do it all. We scout, we screen, we do our diligence. We are privileged to get diligence from 6 state-supported funds. So if any of those funds are in one of our deals, we have their diligence. We also have a terrific network of subject matter experts. And all of this is supported by premiums. Premiums are the amount that you pay to your club for the privilege of being a member. This is a club. We're having fun, right? Okay, good. So lots of opportunities to contribute. You can join our screening team. You can be an angel in residence. You can help out the Invest 360 folks, or you can sponsor. All of these are ways that you can lean in on your club experience. We're going to do a short course today because there's been some demand for it in the qualified small business stock deduction. Who's heard of this? Okay, a couple. So I want to start with a couple disclaimers. I am not a tax lawyer. I am not a certified public accountant. I am an angel investor. And as an angel investor, I am speaking mostly from collected wisdom, anecdote, and personal experience. There are plenty of books and websites about this stuff that you can follow up on. And don't wade into these waters with just what I'll give you. So we have a benchmark in Angel that we want to see a 10x return in 5 years. Those numbers did not get plucked out of thin air. They actually came out of Section 1202 of IRS. And the reason why is simple, because your startup exits, and you got 10x. Woo! And then you pay tax on it. If you take it as income, it could be 37%, plus the 4% you get to the state. If you pay capital gains, you can cut that in half, but it's still a haircut. If you follow the guidelines of Section 1202, you can take it all. Now I totally have your attention, Don. So, how you get a qualified small business stock exemption is your startup has to qualify. There's a few kind of businesses that don't qualify, but most of the stuff we look at here does. And they have to be a C Corp. No LLCs, no S Corps, no limited partnerships. This is just for C Corps. You gotta hold the stock for 5 whole years, and at the end, they still have to qualify. So those are broad, vague things that a tax attorney knows, and I can recite, but I cannot advise. So the exemption is up to $10 million net or 10x capital gain, whichever is greater. Let's do a little example here. You put 10 million into a company, 5 years later it exits, and you get 100 million, tax-free. Yeah, that part always, is met with jaw drops and how do I get some of that? The key here is that it doesn't cover all the deals that we look at. Not just because not all the all the startups qualify, but we don't always hold them for 5 years. I mean, there's all sorts of ways you can point at an investment and say, this is a 1202, and point at another and say, this is not a 1202, and you still have a rich portfolio. So I already mentioned that the startup has these requirements that it follow. Carta and JP Morgan and I think Prudential offer what's called a QSBS attestation letter, which you just put in your file in case the IRS comes knocking. Similarly, a lot of, when you're doing a 1202 deal, a lot of investors will attach an investor rights agreement or an investor rights clause to a term sheet, either as baked into the term sheet or as a side letter. And what that's doing is it's just serving notice. This deal we're treating differently because we want the 1202. Oh, there was one other point here that I wanted to make, which is the hold period means there's no early exits. I'm going to tell you a downside story. I told you an upside story about the 100 million. So I was part of a venture in 2009 that had an early exit opportunity, but the board wanted their 1202s, and they voted not to take it. That company went Chapter 7. It never exited. They had an exit, and they didn't take it because they were waiting for the brass ring, and it never came. So, gotchas. The state you're in turns out to matter. Michigan, great state. Michigan looks at the IRS and says, yeah, we'll do that. California, on the other hand, does not. So if you're an investor in California in a Michigan venture, you're going to pay tax on that. If you're an investor in Michigan in a California venture, you're not. Which begs the question of why is California so hot in startups? Then there's the usual gotchas, which is tax laws, politics, IRS interpretations and precedents, your mileage may vary. So, your takeaways. When you look at a deal, ask yourself, is this one that's going to qualify for a 1202? I don't know if you caught it, but when CultureWell presented to us last year, she made it part of her pitch. We're 1202, we got an attestation letter. She's basically saying to us, do this with us and you will pay no taxes. So that's the startup qualification. The angel considerations, again, use an angel savvy CPA who knows this stuff cold, and then do the record keeping and the decision making accordingly. Don't fall into either of the traps that I just identified, and make sure that it's worth it. So that closes our little mini unit on 1202s. I'll be peppering these pretty much every month. So questions, I will probably say call somebody who's an expert, but if it's off the top of my head, I'm happy to fill you in. What a great program the screening team came up with this month. We have, this is a classic Point Angels program. We've got 2 software, 2 hard tech, and 2 life science. We've got a couple of portcos that we love. We've got a couple of noobs that we are excited about. And then, well, our venture presentations, they really need no introduction, but I'll introduce them later. So first up, I want to tell you a little bit about how I met Ben Kim of Dilemaa. Ben has a really terrific, what's the word I'm looking for? Comes from a great program. It comes from the Burgess Institute at Michigan State University. That's the same program that gave us Brace, the shoelaces that never get untied, and Reel Free, the oxygen hose that reels itself in. So I don't know what Burgess is doing, but they're doing something right. And Ben just bubbled to the top of that stack in a whole bunch of Burgess grams that I filter through my email every month. Checked out what he was doing. It is real. It's so rare that the student startup, has a crazy idea. This is the same as any other founder. You wonder if anybody else has this problem, and then you go out and test it, and you find out everybody does. So without any further ado, where's Ben? Come on up and tell everybody what I'm talking about for the next 5 minutes. Ben Kim and Dilemaa.
Hi everyone, I'm Ben Kim. I'm a Michigan State University student. I'm the founder and CEO of Dilemaa. A year and a half ago, my roommate over here had one of his toughest days in his life. He had his first casual date the next day and he didn't know what to wear. So it was just us, 2 young men in the room, discussing what he should wear to impress his date. Of course, we needed more help to make a better decision. In fact, according to the American Psychological Association, 1/3 of adults and nearly half of millennials struggle with making basic decisions. Gen Z and future generations are likely to face even bigger challenges. But it's not even about the studies, because I posted a video on YouTube about indecisiveness, and I got 155,000 views with thousands of comments saying, I need a platform where I can make better decisions quickly. Welcome to Dilemaa. Dilemaa is a Q&A social media app where people can collaborate and discuss to make decisions together. Just like any other social media app, you can start by posting your dilemma. If my roommate uses this app, have you ask casual date tomorrow, which outfit is better? For people who play golf, maybe you might ask which golf brand is better. And you can optionally, if depending on how sensitive your dilemma is, you can post anonymously as well, so none of your family or friends can actually know you're posting that. And after some input, users can post a follow-up showing what decisions they made. This is so that other users can see real people making real decisions. It's very authentic in the social media realm. And when we first launched this app, we expected Michigan State University students to use this app with about 200 downloads in our first month. We were completely wrong. In our first month, we got 10,000 users from 95 different countries across the world. A lot of them are from the United States, Germany, United Kingdom, India, and Canada. We have more than 9,000 dilemmas and 250,000 total interactions. And we also have an average of 4.6 out of 5-star rating on both Apple App Store and Google Play Store with hundreds of reviews. And we're very excited that we expanded to 120 countries now. And at this point, people start to wonder, what makes Dilemma so special? I mean, sure, we're the only social media app where you can share and solve dilemmas. We have follow features. We don't have fake bots. You can post anonymously if you want. But ironically, that isn't what makes us so special. See, we think that because this is an app, other companies can copy us whenever they want, and feature alone cannot make us special. But what makes us truly special is our community. In Dilemma, we as developers actually use our own app to ask users, what feature do you guys want, or what bug should we fix the most? Because that is the biggest dilemma we have as developers, so we don't waste time on building things that people don't want. Users often post how wholesome, positive, and supportive our app is compared to other toxic social media apps. They even make Discord servers so they can play Minecraft games together. And sometimes designers send us mock-up designs so we can improve our overall app design for free. User loyalty, where users genuinely believe in our app, that is something that other companies cannot copy from us. You can scroll on Instagram and TikTok for hours and feel guilty that you're wasting time. But when you scroll on this app, you're not wasting time. You're helping people make better decisions. That's what makes us special, and that's what makes us better. And Dilemma is not just for individual users, but also for businesses. As we already have tens of small business accounts using our app to validate user preferences, such as what logo should I use, or what thread should I sell. We recently had a snack company using it for asking, what flavor should I make next? And this directly ties into our revenue model, which is offering data insights to businesses about trends in consumer decisions. Two other ways are advertising and offering premium paying as well. Dilemma on the front end is a social media app, but on the back end, we run a data business. We collect such high quality on user preference, such as why do people choose option 1 over option 2. Providing that data sets to businesses is a very lucrative idea. However, in 2025, we plan to increase our user base first, and then we plan to add the monetization by the end of 2025 or early 2026. So, investors from Pointe Angels, I think you have a big dilemma. I know this is a really good presentation, but you might wonder after this pitch, should I talk to Ben or maybe invest in Dilemma? Well, what can I say? If you need help with that dilemma, I invite you to Dilemma. Thank you.
Nice job, Ben. A lot of us go to on demo day in the fall. On demo day, I was privileged to match with TreadCycle, Detroit startup that is using some really cool technology to do some really important stuff. And without further ado, tell us what that really important stuff is, Ethan. You have 5 minutes.
A few years ago, I woke up to a crime scene outside my home on the west side of Detroit. Not one of violence, but of neglect. Hundreds of tires had been illegally dumped across the street from my home overnight. There was a mountain of rubber abandoned in an abandoned lot. It was leaching chemicals, it was attracting pests, and it made our block a hazard zone. I was a lawyer at the time, but that day changed everything for us. I started researching where tires go when they die, but more importantly, where tires go when they don't go anywhere at all. They end up on my block or somewhere else. That search eventually led me to Italy, where I discovered a quiet revolution in clean tech recycling, and it sparked the idea behind TreadCycle. My name is Ethan Dunn, and I'm the founder of TreadCycle. And TreadCycle is the first North American company licensed to use a proven water jet technology for recycling giant off-the-road mining tires. Tires so big they don't fit in shredders, they can't be cleanly burned, and they're oftentimes buried on site. We use high-pressure water jets, originally developed for aerospace applications, to precisely dismantle these massive tires to create clean rubber and recycled steel. There are no flames, no shredders, and no pollution. It's not experimental. This technology has actually been in use for over a decade in Europe, and we're bringing it to North America for the first time. Right now, mining companies have very few options. Most either stockpile their tires, they bury them on site, or they ship them overseas at a very high cost. The status quo is not only dangerous and dirty, but oftentimes it's illegal. What our method does is produce a higher quality material, avoid emissions, and reduce both environmental and operational risks for our clients. And we're the only team positioned to deliver it at scale in North America. We hold a territorial license with exclusive rights within 200 kilometers of any facility we build, and we are the first mover in this market. Here's where we stand. Our engineering team is ready to build the first U.S. facility. We've lined up our strategic partners for construction, logistics, and resale. We have signed an offtake agreement for 100% of the recycled rubber and steel that we manufacture, and we're already in conversations with mining companies that are ready to send us tires. This is not a prototype, this is shovel-ready infrastructure. Our next milestone is completion of construction, where we're raising $7 million in equity and $13 million in debt. Once the first facility is live, we'll replicate this model across other protected territories. We're positioned to own the OTR recycling space in North America, and every tire that we process keeps waste out of the earth and materials in the economy. If this sparks your interest, I'd love to talk to you further. Thank you.
Ben, I wonder if you could come back up and smile for the cameras so that I can memorialize the moment of your presentation, which I somehow did not do last time. And look as if you're speaking to a terrifically rapt audience.
Rob is crazy.
Yeah. All right. Excellent. Thank you.
Awesome, thank you.
Too many things to think about. Too many moving parts. Magsorbeo is an interesting story in that we previewed this venture in November of 2022, and then they came and did an update the following year, November 23. That's an important meeting. You'll see why in a minute. But they've never actually given a venture presentation and made so much progress in the time since we first looked at it. So now that they have hit a couple of milestones and are embarking on the next phase of their growth, the screeners would like you to see Magsorbeo Biomedical for 15 minutes, followed by your Q&A. There you are. The down button advances slides. And I think you have some appendix slides as well. All right. Jake Edick with Magsorbeo out of East Lansing. Your 15 minutes begins now.
All right.
Down button. There you go.
Got it. All right. So the future of orthopedics is metal-free. If you go talk to Zimmer, Johnson & Johnson, or Stryker, they're all going to tell you that the future of patient care in orthopedics is metal-free. And when you look at absorbable materials in the orthopedics fixation space, they haven't quite gotten the adoption yet that they need to get to be successful. And that's why our team founded Magsorbeo, because absorbable alloys and absorbable materials in the implant space have the opportunity to improve outcomes for millions of patients every year, saving healthcare systems billions of dollars, and our mission is to finally deliver on that promise. So in the US alone, every year, there are 2 million orthopedic fixation surgeries, so think plates and screws, implants that go into your broken bones to hold them together while they heal. The challenge here is these are implants with a very temporary function, but they're often left in the body permanently. And at that point, a decision needs to be made between the surgeon and the patient. Do we remove that piece of hardware, or do we leave it in and risk and deal with the complications? In the case of pediatrics, it's 100% removal. Those implants will impede growth.
On the opposite end of the spectrum, you get older patients who've had implants in their body for decades. They cannot come out at this point, and they might need a knee replacement or a hip replacement, and they can't get it because that hardware is in the way. So why is that? It's because those implants are difficult to remove, they're dangerous, they're risky for the patient. The lucky few who have these severe complications, they might get their hardware removed. But in the US healthcare system, we do everything we can to not remove that hardware. Again, it takes a lot of time, trauma, and cost. It's risky for the patient. Surgeons don't like doing it. We're looking at a lot of repeat visits to the hospital, a lot of targeted antibiotics, a lot of trauma to the patient to get through to the end of that journey. And when they get the hardware removed, 16 days recovery, 16 days away from work or school. But those lucky few, that 20% that make it through the end, report huge improvements in reduced pain and improved function. So the question is, how do we get those same results for all patients? Really simple, right? If these implants were just absorbable, if they went away naturally, we could get to that same outcome for all patients without all the time, trauma, and cost. The challenge there is finding the right material. You need strength, and you need the proper absorption characteristics. Resorbable polymer, it's been around for a while, doesn't have the strength, limited adoption. First generation of absorbable metal technology, magnesium implants that go in the body, they don't yet have the absorption characteristics. And so that was the opportunity for us and why we invented our patent-pending CureAbsorb alloy. So this is a proprietary alloy backed by 2 patents. It does a couple key things. One, it has a nice controlled absorption profile. That's what you see in the chart. Compared to our competitors, they have an uncontrolled, predictable absorption where that really lacks performance. So we excel in that. We can also adjust our alloy absorption. Those are 2 things, again, backed by our patents that give us a huge competitive edge, and I'll get into that in a couple more slides. One of those competitive edges is coatings. Our competitors rely on coatings. The only way that they can control their absorption is if they have a coating. Those coatings are ceramic. Ceramics don't bend. You don't need to be a smart material scientist to understand that. So that really limits their overall addressable market. They can't do plating systems. Things like plating systems need to be cut, bent, and shaped. That opens up a much larger market, again, because we don't need a coating. It's all enabled through the metallurgy of our proprietary magnesium alloy, and it opens up a much larger market. So where we are compared to our competitors. First, kind of going through the magnesium competitors, Syntelix, first to market. They were CE marked, sold in Europe starting in 2014. They did a lot in terms of telling us that these are implants that are safe for the patient. There are no systemic toxicity concerns. We can also get good performance out of these alloys if we control absorption. The problem is they didn't do that. Next entered Biorotech. So Biorotech, they controlled absorption a little bit better, not quite there yet, still a bit to be desired, but what they did do is they were the first to get their de novo clearance through the FDA in ortho extremities, so foot and ankle fixation. This is really key because that really opens up the regulatory pathway in the market for us and for everyone else. Another key one in there worth mentioning is medical magnesium. So medical magnesium, they weren't the first to market in any place, but they were actually the first to exit. So recently acquired this last fall by another German company, a larger medical device company called KLS Martin. So looking at all of those competitors, we not only have a much more simple and straightforward technology, we also have the only US-based domestic supply chain for absorbable metal implants. When we talk to the strategics, that's a huge advantage for us as a business and for them when they eventually acquire us. Another last one worth mentioning is Alisio. So Alisio is a next-gen resorbable polymer. Technically, there's not a ton that's special about it, but what they've done that's really interesting is they've done a lot of direct-to-consumer marketing. They've been educating patients about the option for an absorbable material in these procedures. Those patients are going to their surgeon, asking for it, and they're getting it. So Alisio just raised a $27 million Series C. Surgeon feedback. Again, it all comes down to time, trauma, and cost. We've done a ton of one-on-one interviews with surgeons, over 100 at this point. We've given them the prototypes, and they say a couple things. One, it handles just like titanium. 2, if this handles like titanium and absorbs, this is the holy grail. This is the next evolution, and it's something that's so valuable, we would be willing to pay a premium for it. What's interesting about our technology is we don't need to charge a premium. We are the only absorbable metal technology that does not charge a premium. We don't have the coating like our magnesium competitors, and the COGS on polymers force them to charge at 1.5 to 2x selling price to make up for margin. So So we have a huge cost advantage, we're a premium product, and if we do decide that we can sell at a premium, if the clinical data backs that up, we can increase margins. To quantify some of this feedback, surgeon surveys have told us quite a few things. Notably, 90% of surgeons said they expect patients to benefit and they would adopt this technology. So what are we doing? This is a platform technology. We need to roll it out into some specific applications. So as I mentioned, BioRetech had their de novo cleared. That means going into ortho extremities is a traditional 510K. We've spoken with the FDA about that. They've agreed. So our first indication is an ankle fracture. To get to that 510K, we need to run a first-in-human clinical study. FDA has also agreed to allow us to do that in Australia. Doing it in Australia gets us to market faster than doing a clinical trial here and then doing the submission. So it's a much faster path and a cheaper path to first-in-human data and market clearance in 2027. After that's our de novo clearance in maxillofacial. That one's a de novo. It's a different group at FDA. We've spoken to that group several times as well. We've done 4 pre-subs in total. They've agreed to the de novo pathway. They've agreed to the testing plans that we put in front of them. And for us, importantly, because we are the first and the only ones in that space, that's why it's a de novo. For us, this allows us to do a couple things. One, that's a specific market where polymer dominates. On the absorbable side, they do 20% of the market. It's roughly half of the maxillofacial, so everything not mandible. That's a huge market opportunity. We can scoop in, we're a superior technology, we can take that market right away. The other big thing does is it demonstrates the versatility of our platform to the strategics who are eventually going to acquire us. These are huge markets. That's where we're starting to get us there. We have got a couple of partners, BioPro and Extremities. So both of these are Michigan companies. BioPro is a partner of ours both on manufacturing and design in ortho extremities. They sell in that space. Their surgeons are ready for this technology. They sell in 500 hospitals today. Next is C2DX. So C2DX is on the MaxFace side. They're all former Strykers. So they launched Strykers 2 resorbable polymer systems in the Stryker craniomaxillofacial portfolio. They're very well qualified to do this. They sell a portfolio of their own of very complementary products to our implants. So they're going to roll that out. And then on top of that, moving forward, we're in the middle of discussions with some of these large strategics about design to spec. So these implants require instrumentation to implant them. All the strategics have their proprietary instrumentation sets. So what the discussion is we would design implants that are compatible with their instrumentation so they can sell. All of these agreements are going to be non-exclusive with change of control. The ultimate idea is we get lots of different people selling, and if you want exclusive rights, you have to buy the whole thing. That's the motivation for them to buy us and exit. So where we are today. We've closed out, we've done our preclinical study, our initial preclinical study. We've got 2 more coming up with non-dilutive funding. One of those is with our NSF STTR grant recently awarded just a couple months ago. We've worked with FDA, the large strategics, to build out our go-to-market and regulatory plans and strategy. One of those strategics, we just finished up an accelerator between Plug and Play Ventures and Zimmer Biomet. That was a couple months ago, and then starting next month is our next accelerator, in part due to sponsorship by Zimmer Biomet. That's MedTech Innovator, and if anyone knows MedTech, the MedTech space and MedTech Innovator, there's nowhere to go upward from there. I mean, that's it. It's 1,500 companies applied, 65 got in, we're one of them. And then engagement with strategics, that's key. I'll touch on that in a minute. We're heavy there. So myself and Carolyn, we're the 2 co-founders, both experts in metallic biomaterials and absorbable metal implants. So at Boston Scientific, we worked on a project. I did the alloy design. Her expertise is in the absorption characterization and preclinical testing. We designed that magnesium alloy for stents. It's currently on the market in Europe in stent applications. Joining our team are Christian and Marcus out of Stryker. So again, former Stryker craniomaxillofacial, expertise on the engineering of implants and instrumentation, marketing, product development. And then Amy Gallardi is our Chief Commercial Officer, comes with background sales and marketing out of the clinical trial side of the industry. Rest of our team, entrepreneurs with successful exits, clinical and regulatory experts. We've got an awesome team of KOLs, both US and Germany based. These are KOLs who, when they get on stage, people listen. These came directly from Stryker and the strategics, so they have heavy connections. And Dr. Wilfang and Wagner, they're in the University of Schleswig-Holstein in Kiel. They are contributing a lot of non-dilutive funds towards our development. So where we are now, we are raising a $1.2 million seed round. I'll get to the terms in a minute here. But what that's going to do is that's going to finish out our development, finish out our first in human clinical plans for that clinical study I told you about in Australia, and then allow us to do the testing. The next round, C plus, will be at $2 million. Both rounds are being led by New Fund. We initially wanted to do one round, we split it into two. The valuation will go up after this round, this current 1-year round on the $1.2 million raise. From there, Series A will be commercial launch and expansion in the extremity space. Very similar on the max face side. We're doing 2 preclinical studies in maxillofacial fixation, both completely funded by non-dilutive throughout the rest of the year, but extremities is the major priority right now. So looking at exits. Exits in this space are huge. Everything you see here is a smaller addressable market than what we can address, so we expect to have a larger exit. The other story here is fast followers. So we are obviously a fast follower with a superior technology in the space. Medical magnesium already exited. I don't have the terms. It was 2 private German companies. Nobody I've talked to will spill the beans on what that is. I've talked to investors. I've talked to people at the company. Can't get the info. The other important thing here is Embody and Biorez. Embody was the first exit. Biorez was the second one. Very similar technology, same market. Biorez barely had any revenue, 250x multiple as a fast follower in that space. So for us, our exit window is going to open up in 2027. And that's on the back of the clinical data and then that 510K. Again, we're a fast follower. Everyone knows what this technology does. They know the potential. We're engaged with those strategics. We know they're interested. And the exit window only gets larger from there. Our base case exit 2029, comps are up there. Worst case, conservative 2031. But again, 2027 is really where our sight is set. And that's, again, coming out of that first human clinical study. So again, New Fund Venture Group out of San Diego is leading the round. It's a total of $1.2 million. Convertible note, $8.8 million cap, 10% interest, 20% discount. We have about 500,000 left open on that round. And again, use of funds, getting the data, finishing out development, and getting IRB approval for that first in human clinical study in Australia at the end of next year so we can launch. And with that, we'll open it up for questions.
All right, catch my eye. I'm going to moderate the Q&A. We're going for quantity. For quality, you will follow me. Jim, and then Craig, and then Kristen.
You mentioned the 1.2 million raise with use of funds would be development. Can you talk a little bit more about what it is that's not yet complete and that you have to resolve or improve?
Yes. So we've got the alloy pretty well set. It's just getting Christian and Marcus on board to finish out the mechanical design and then also do the instrumentation. So that's a little bit of an investment. It's not hard work. It's just it's just work that we need to do so we can lock everything before we start those GLP studies. So our preclinical studies need to be on final finished device. Right now the alloy is on final finished manufacturing, so we've got that piece of it down. We just need the money to take it the rest of the way to lock mechanical designs, do our sterilization validation, just dot our I's, cross our T's to collect the data in those more expanded preclinical studies.
This is what I think I just heard. You can't collect the data with what you've got now. The use of funds does some mechanical so you can collect the data.
Exactly.
I like that. Craig and then Christy.
So you talked about your patents. Can you tell me a little bit more about what they cover and what they won't cover?
Yeah, so the first one is alloy formulation. So just what are the mixture of elements that go into our alloy and really give us protection there. So it's a patent of mixtures. The second one is a patent covering the specific microstructural features that really drive performance. So think process patent, but not a process patent. Think about what the process creates and what's really important to drive those absorption characteristics that are really necessary. So that's something that's really unique to us, that patent is really a key defensive patent to block out our competitors from doing what we've done with a different alloy chemistry.
What were the dates for those?
The first one we filed in 2022, the provisional, and the provisional for the other one was filed last year. Both are non-provisional. And we fast-tracked that second one, the microstructure one, so we should get judgment on that in the next year.
Kristen.
Could you clarify who the customer is, presuming, and the go-to-market for that, presuming there's a customer or a market post-clinical trials and and then before the exit that you talked about?
So the customers are patient, surgeon, and the healthcare systems.
All of them?
All of them. So all of them, so especially in elective procedures, like in Alio's case, in these elective procedures, the patients, when they're educated, they'll go find the surgeon that's gonna give them that absorbable implant. Then you also have to convince the surgeon that they want to use that. And then in the large hospital systems, you have the value analysis committee who has to let you in. So our go-to-markets in the small clinics, we're gonna skip the hospital systems, large hospital systems, go to small outpatient clinics where surgeons make the buy decision. So that's our focus. Our also specific targets are going to be where's osteo being used, and as BioRetech launches, where's BioRetech being used. Our plan is to target those surgeons and give them a better product.
Let me follow on Kristen's question. Who pays for it?
So it's paid for by the payers, the health insurance companies.
Who prescribes it?
So the doctor's going to prescribe it. It's done by procedure. So it's a capitated model. So
Got it.
yeah.
Capitated.
That's the healthcare term.
Okay, cool. Kurt, what's up?
If you break your ankle, the healthcare insurance company will pay the hospital for a broken ankle, no matter how they treat it.
And they lose money on some patients and then they lose.
My question is, what have you done so far that you see how this works?
Yeah, so we've done extensive benchtop studies. So we went so far as to go to Europe and get our competitors' prototypes, or our competitors' actual product, and test them against our prototypes. So we've got lots of benchtop data on that, just showing exactly that we can get that optimal absorption profile. And then we took that and we put it in a preclinical study, and again, collected preclinical data. So the first step was bench. We collected lots of that and then confirmed in the animal.
Like with
Say
something
pig jaws.
Pig jaws.
It's something that's like biodegradable, I understand the variable seedlings. Well, dissolves in solution to its liquid seedlings.
Yep.
Specifically, how are you testing this information?
Yeah, so our benchtop model is just that. We drop it in a biomimetic solution and we measure the mass loss. There is a bit of know-how and art to doing that. That's Carolyn's expertise, and that's expertise that we gained at Boston Scientific. That's a key piece of this. Is we're using a lot of the same techniques that we used on that last alloy. Our corrosion test is one of those techniques.
And that's correlated to the clinical trials you're going to use?
Yeah. So that's one of the big things that FDA specifically wants to see, and what we have been working on and others have worked on and published, is that in vitro to in vivo correlation, and being able to show that how we test on the bench does correlate to ultimately a preclinical model, and then from there that the preclinical model translates to a human model.
Pig jaw.
Big deal.
Pig jaw.
Bill and then Jimmy.
Harvey.
Darby and then Jimmy.
What's the cost of your product versus traditional stainless?
Yeah, so our COGS are right in line. So magnesium itself is a little bit more expensive, but the overall contribution to the total COGS is a few pennies when the part's $25, $30 after machining, packaging, and sterilization. So there's really no impact to COGS.
And then what's the absorption time?
Generally 9 to 18 months is our target. It's really going to depend on the specific application.
So you don't lose structural during the healing time is what?
Yeah,
6
so
to 10
our
weeks?
alloy, what's unique about our alloy is we have engineered it so that it actually starts really slow and then accelerates from there. So that's how we make sure we maintain that structural integrity.
The one competitor, I can't remember the name, so they went to market and created demand from the consumer side. What's your take on that model, and would you emulate that?
Is that the Alisio that you're talking
Yeah, I
about?
couldn't remember the name, yeah.
We've had discussions about that. We don't see a reason to. So Alisio, as far as we're concerned, is doing that for us. And again, we've talked about just poaching those surgeons. We have a better product. Their screw is still plastic. We can give a metal. And so we're just going to find those surgeons. We're going to poach. That's going to be our #1 sales tactic.
But when the patient asks for that specifically, now you have to have the surgeon essentially swap out the request for your offering.
Sure. But if you're a surgeon, then you can say, well, I can give you an absorbable one, but this one's better. And this one's more reliable. And in the case of maxillofacial fixation, they can't get that product. So there are things that we can do, and again, we have better performance, that if the patient comes and asks for a specific absorbable, it's easy for a surgeon to say, oh, I can give you an absorbable, but I have something that's actually better. And that's what we want to do.
Is the recommendation purely on what's best for the patient, or is there a monetary value for what they choose?
It's all of the above. So when it comes to the surgeons in the hospitals, they do often lose money on removal procedures and treating those complications. They also hate doing them. Those surgeries are really messy. They're not good for the patient. And so at the end of the day, it does save both money for the surgeon and the hospital and give the patient a better outcome with less time, trauma, and cost.
I'm curious if you could explain a little bit more detail how it's different from the competing magnesium-based products. For one thing, I guess you probably haven't had an office action yet, but if you're comparing yourself to the other products, how would you differentiate? If the surgeon's going to recommend one over another, what's the surgeon going to say? That sort of thing. What's the differentiation?
Yeah, so didn't get into it too much here, but it's all about that optimal absorption. So what our competitors, especially Syntelix, have done and what we've seen is they've had a failure rate in clinical use running at about 20%. And that's because of that uncontrolled absorption. For us, it's controlling that absorption. That's the functional differentiation, but then how we do that is what's protected in our IP. And we have very specific metallurgical features that we've patented that are hard divergent from what they even have in their patent. So if you go read their patent, they say they do this, they want these features, and we say, no, don't do that because you're gonna get those poor absorption characteristics. You need to do this, and this is what gives you the proper absorption characteristics.
So when you do the clinical trial, do you have to compare it to the other?
We're gonna compare against titanium. They've never compared against titanium because they can't compete against titanium.
Okay.
Can I follow on? So when you said you're gonna target the surgeons, not the consumers, what's your approach to that? Like, how do you go about that? How many people? Is this like a mass outreach? Is it a sales team? What do you do?
Yeah, so those KOLs, that's important. So conferences, getting out and just letting people know what does the clinical data. Surgeons are driven by clinical data, so that's number one. Again, that's why we're going to Australia. Our key to success is getting good clinical data as fast as we can get it, disseminating it through the conferences, and then through the professional societies as well. So actually, as of earlier this week, American Society of Plastic Surgeons on our cap table. That's through the MedTech Innovator Program that I told you about. So it's building awareness through those societies, through conferences, and getting the clinical data in front of them to educate them. And then using a good sales force, like the two that we have, and then the strategics, especially when they come on board, to help further push it into the clinic.
Is that work you do or the channel partners do?
It's going to be a little bit of both. It's going to be a team effort.
Are you the content developer and they're the disseminator, or is everybody spinning?
So we are going to develop the majority of the content, and obviously when it comes to marketing claims, it needs to go through the FDA. So that's what our big focus is now. So they can really only market to what we get cleared through the FDA and to the data that we generate. So that's our major focus now. That's why we have these discussions with them to get that package done, because it needs to be done on the front end, can't be done on the back end.
Some good slides on the stages before errors and your trials, and also on the exit comps. The exit comps are because they were based on revenue. And so could you speak to, are you going to take the company through all the trials and start generating revenue, or is it an opportunity?
That is our base case and our worst case. Our best case, again, on that fast follower scenario, is very minimal revenue. So that BioRes acquisition, going BioRes in body, we see that in medtech right now. If someone exits, and we've already seen an exit in this space, if someone exits and the strategic interest is there, you can get picked up early, and we expect that. I mean, and again, we are so deeply engaged with those strategics that they are waiting for this clinical data. They came to us and asked about sales and distribution. They came to us and asked us to be in these accelerators, so they want this technology. So we're really bullish on an early exit. We know it's possible, and we know how to do it.
Okay.
From a risk management standpoint, what are the side effects of absorption?
The biggest side effects that we've seen are just not controlling the absorption and actually getting a failure of the implant, and that's where our competitors have struggled. We've seen no issues related to systemic toxicity or local toxicity, and that's even coming after Syntelix. So the very first to market, they had 7% rare earth elements in their alloy, and a little bit of zirconium, which is a neurotoxin. They still got CE marked, and there were still no negative outcomes associated with
Mercury,
toxicity.
polonium, plutonium?
Yeah, we don't have any of that.
Okay, good.
We're sticking all natural. But anyways, they set the bar pretty low, and they were still successful. So again, we're a fast follower. A lot of those basic questions have been well de-risked.
So you use a pregnant mom without any fear of absorption?
We would not be able to market to that. We would have to, without running a clinical trial, we would not be able to market to that. So that would be a doctor's decision. I would never go tell a doctor to do that, at least not without the clinical data to back it up.
And this is typical for FDA. Your indications for use say what patient population.
Exactly, and anything. I mean, we've already talked to the FDA about this. Pregnant moms, osteoporotic bone, patients with diabetes, any sort of the typical bucket of pre-existing conditions, you have to contraindicate for those unless you go and run in a super expensive clinical trial. That's not our focus. Our focus is just showing that we compete head-to-head against titanium. We know our competitors can't. We're going to do that in a clinical trial, and that's the big focus. From there, some of those decisions about what subpopulations to target, patient populations to target and get indicated for, that'll be ultimately left to the strategics who acquire us.
The big differentiator for me from when you were in front of us last time to now is the big jaw. That's why I keep prompting you to. Could you please just talk us through for 30 seconds the whole big jaw study that you were talking about doing last time you were here, and now you've done?
Yep. So we did a maxillofacial model, and we implanted our plate prototypes into the face. That actually was a sheep and not a pig. And we've got another sheep study coming up in July, and then another one coming up in September. But basically, that's as challenging as it gets. So it's a bit lower bone density than what you see in the lower extremities, and it's faster blood flow, and it's also a thinner implant section. All of those things make it more difficult to do, and we rocked it. So we were able to show that we controlled absorption in a very tough environment out of a tough mechanical design, and we were able to do something that no one else has done. We have yet to publish that data, partly because we don't want people to nip on our heels too closely. Our competitors, we are going to publish it
My
later
next
this
question
year.
is if you published it.
We've been purposely delaying it because we want to stay in stealth mode a little bit and not tip our hand to our competitors.
Very cool.
Why didn't you mention that when I was asking you how you tested this?
I did. I said it in vivo.
I thought you were talking about solutions and all.
Yeah. So we've done both. Yep. So preclinical in vivo.
All right, one more minute.
Yeah, just that and the histology images showing the good bone to implant contact and showing that by controlling absorption, we get good reaction with the bone. That's where our competitor struggles. When they don't control absorption, the bone starts to not contact the implant the way that it needs to, and that's exactly where we excel by controlling the absorption, is we maintain strong contact with the bone.
Thank you.
Thank you.
Shake it, Magsorbeo. Yeah. Oh, okay, wait. Okay, that's a good one. Okay, Matt? All right, that's a good one. This actually answers Monique's question.
I think you guys are backup slides.
There we go. You were prepared for everything. Yeah, that's.
I present to a lot of doctors who ask
Yeah,
a
I'll
lot of
bet.
really tough questions, so I gotta come armed.
And we're a tough room, but for a different reason. Our next venture presenter, we met at the Michigan Venture Conference. So the venture conference that takes place in the same building and at the same time as the Growth Capital Symposium, but is the student version of that. They've held it now for 3 years, brought in a real interesting variety of ventures, including one that, as I'm talking with angels in the room, you've all heard of. So I'm kind of late to this party. Alisio and Nishan, where are you? There you are. Fill everybody else in on what, fill me in on what everybody else seems to know. Down button is the advance.
Okay, great. So my name's Nishan Dixit. I actually grew up here. I grew up in Grosse Pointe, went to Liggett. Used to live in the U.S. for quite a while, and then lived outside the U.S. for a long time, and then realized that Detroit and Grosse Pointe are a great place to go raise a family, and came back. So I work on a company called Alisio.
which refers to vientos alisios, which in Spanish are trade winds. We empower manufacturers to get paid faster, qualify for more contracts, and grow cross-border. A little bit about me. I grew up here, as I mentioned. I went off to college in New York at Columbia, and I have two parents that are doctors. I don't know if you have South Asian friends. They also wanted me to be a doctor. I escaped. I went to college at Columbia, and I originally thought I wanted to be a diplomat. And so I studied Middle East Studies, political science, went through the interview process with the State Department, realized that all the junior level employees at the State Department have to do visa processing interviews for people that want to come to the US. And I didn't want to be the guy saying no to the American dream. So I decided working for the State Department was not for me. And I went on to go work for IBM straight out of college. I looked at expansion for IBM in emerging markets. We looked at IBM in Brazil, Argentina, Philippines, fell in love with tech, fell in love with emerging markets, went on to go work on a tech startup called Gyantel. Gyan meaning knowledge in Hindi, tel like telecom. We used to do software for your typical mom and pop bodega in an emerging market. So if you can think about a place where you go buy pop or chips, we were doing that in first in Hong Kong, where I convinced my co-founder, who was from Argentina, to move out to Hong Kong, quit his job, be my roommate, be my co-founder, start a business, and we brought that company into India. We did work in India with these traditional mom and pop shops, expanded the business from India into Latin America. We did work in Colombia, we did work in Brazil, and then we did work in Mexico, and we sold it to a Mexican AI company. And our main focus was basically helping small businesses, your typical mom and pop, work with their suppliers. So your typical sort of like Costco equivalent. And so we help them order from suppliers, track sales and inventory, accept payments, make payments, and then exited the business to a Mexican AI company. And I moved back up to the States with my wife, who's from Colombia, and I had always wanted to do something focused on US and Latin America trade. And my co-founder for this business is Manuel Zamora. Manuel started a tech company called Dailies. He's also worked on a company called Construction Site, which was later acquired by Drone Deploy. He's worked on Certified D, which basically is trying to eliminate wire fraud. And Manuel is Lima born, LA raised, participated in 500 Startups SF 2 times. As an advisor, we have Tyler Gill. Tyler started a company called Strong Room, which is accounts payable software company. He sold that to Avid Exchange. Avid later went public on NASDAQ back in 2021. And Tyler managed a lot of the relationships with banks and ERP software companies, so NetSuite and Sage. And we focus on the fact that supply chain finance has not changed in more than 30 years. And when I say that, since 1994, NAFTA has enabled cross-border trade. If you go out and look at the Ambassador Bridge, all you see are trucks going back and forth with car parts. If you went down to the Bridge of Americas in Ciudad Juarez, that's what you would see as well. And ironically, your typical auto parts manufacturer, whether it be in the US, in Mexico, or in Canada, still waits more than 120 days to get paid. And it's fair to say that in manufacturing, cash moves slower than goods. And that's a huge problem because it slows down trade. And even though there is more than $0.7 trillion in demand for trade finance, and US Latin America trade, which is mostly US Mexico trade, is at $476 billion, and $158 billion of that is automotive parts going back and forth. It could be much larger. It could be a lot larger if we included more of these SMBs. I think you'd be surprised to know that $84 billion of that trade is Michigan-Mexico trade alone. We focused on Canada, but Mexico is actually one of our largest trading partners. And so we found that the implications of this are that only 40% of SMBs are receiving the capital that they're asking for. And this is from a Goldman Sachs 10,000 Small Voices survey. And it's fair to say that banks are slow, they're expensive, and generally speaking, they're not really helpful. And so as a result, 86% of manufacturers are seeking real-time payment tools. But what are the costs of credit lines being pulled or financing not being existing? And you're finding that a lot of these SMBs are halting their expansion plans. They're talking about shutting down. I've had conversations with suppliers where they're saying, look, I could go do a deal for Valio, which is the large tier 1, as many of you probably know. I could go do a deal for Webasto. but I couldn't do a deal for both at the same time. And in this environment where tariffs are coming in, a lot of them are really struggling. They have 30 to 60 days of cash on hand. And the tariffs obviously are a huge issue for them, but the other part of it is this chaos of the entire conversation about tariffs is meaning that contracts are being paused. And once contracts get paused, there's so much confusion in the market that banks will pull credit lines. And if they pull that credit line, then you're actually in a catch-22 position. You're not able to go qualify for other contracts. And then what do? You put your labor force on 50% time. You start thinking about, do I go sell my factory and maybe do a lease back so I can go get some cash flow into the business? And this is what most family-run manufacturing firms in the Midwest, in Canada, in Mexico are confronted with on a regular basis. And so we went out to go talk to manufacturers in Mexico, in the US, in Colombia, in Brazil, and overwhelmingly what we heard from all of these manufacturers was cash management was the largest issue that they faced. Getting paid on time took a lot of time and effort. You would have to float 120 days. You might say no to a deal because you couldn't float the 120 days. Dealing with international transfers was a huge block to you going cross-border. And in many cases, you need liquid capital to just self-finance a deal. And that's obviously pointing to working capital issues. And so, Alisio at its core is a vertical AI platform that enables, that streamlines your financial workflows and payments to unlock access to growth capital. So we help manufacturers get paid faster, qualify for more contracts, and scale cross-border. We do that by giving payment tools to your financial controller. As you can imagine the situation for your typical financial controller at a tier 2 or tier 3 manufacturing firm, you have a CEO or CFO sitting on your head saying, hey, go find me more cash so that we can qualify for another deal. And you're not in a position to do it. You're stuck with Excel. You're using Excel to go get 5 or 6 different CSV outputs from the different banks that you work with. You're using an antiquated ERP system, which is not SAP or even NetSuite. And on top of that, you're using QuickBooks. In many cases, we've got companies that we've talked to where they've grown to $8 million, $10 million in revenue. It's a company out of Roseville, Michigan called SMT Automation. And the founders of this company, it's a great story. They originally were Marco Santana and his wife Elena Morales. They were in Ciudad Juarez. And Elena ended up getting a great job with Continental, moved up to Auburn Hills, and got their entire family out of Ciudad Juarez, which in 2010 was probably one of the worst places you could live in the world due to drug violence. They ended up moving up to Auburn Hills and really went on and lived the Midwestern Detroit dream. They went and started their own manufacturing in 2017. And they started doing well. They started getting to around $7 to $8 million, $10 million in revenue. They work with Stellantis. They work with a lot of the tier 1 suppliers that are out there. But now they're confronted with a situation where Huntington Bank has decided to go pull their credit line. When they started the business, Elena is much more process-oriented. She used to do process consulting for Continental, but also used to work in purchasing. And she handles the books. Marco doesn't trust anyone else to go handle the books except for his wife, which is great. She's really smart. She's got an MBA. But she's not a treasury management expert, and she shouldn't have to be. Most of the manufacturing firms that are out there, they want to go make parts. They don't want to be treasury management experts. And so what we do is we empower your financial controller with vertical AI tools. So we actually go in through your inbox, and we enable via the inbox at billings@whatevercompany.com for you to go parse your email. And we'll say, this is an accounts payable issue. This is an accounts receivable issue. We'll go even further than that. We'll actually go in and do quote the cash via the message that we get there so that you're able to go in and create trade compliant invoices. We can do pro forma and cross-border. And then on top of that, we allow you to collaborate with trade partners. Why are invoices paid late? A lot of times invoices are paid late because you didn't put in the right format. In other cases, to be honest, and not cynical, but sometimes larger buyers just don't want to pay you on time. That's a different story. But I mean, you want to minimize the number of reasons that you're giving them, and so we enable you to do that. So we'll allow you to go do your invoicing. We also allow you to do cross-border payment, and then on top of that, we'll do fintech factoring. So once we know what you've done on your payments, what you've done on your invoicing, we can help you qualify for 30, 60, 90-day financing. And we'll connect with your existing tools. So we'll connect it via API into QuickBooks. If you're in Mexico, we'll connect into Compact, which is the Mexican version of QuickBooks. If you're in Brazil, Contazul. If it's in Colombia, Sigo. And we're giving you a single source of truth for what's going on with your real-time cash flow. Then on top of that, what we're doing is it's a vertical AI with embedded finance model. So you pay for your transactions and you pay for the financing. You don't pay a per seat fee. And underneath that are what we call our Alisios, which are essentially an ecosystem of AI agents. So as I alluded to earlier, we go into your inbox. If you get something in at billings@whatevercompany.com, we parse that inbox. We decide this is AP, this is AR, etc. We then take that to Full Send, which is our quote to cash agent, which is essentially allowing you to go create this invoice in real time. And then from there, we have Pointe, which is allowing you to take control of your cash. So that's checking your cash position on a regular basis and giving you recommendations on how you can get paid faster. And then finally, when you actually do want to go get paid faster, we will help you factor that invoice through Levante. And when we do that, we work with Allianz. So Allianz will go in and grade these trade receivables in real time. They will give you trade credit insurance on them. It covers up to 95% of the invoice value. And Allianz will go rate your trade counterparty. They'll go rate Tenneco. They'll go rate Magna. They'll go rate any of these other large tier 1 suppliers. And to give you a sense of what these ratings look like, Apple pays all their net 30s on time. They pay all their net 60s on time. It's maybe the way that manufacturing should be. They're a number 1 rating. Tenneco, prior to the acquisition by Apollo Private Equity, was at a 6 out of a 10 rating, which is pretty bad rating. Then when Apollo came in, bought them, and then restructured it, they became a 3. If you're not familiar with automotive, I'll come into how that rating system works. But our product allows you to create an invoice, apply for financing. We can give you pre-shipment, post-shipment financing, and once we're paid back by your buyer, we pay the rest of your invoice less the financing charges. So it's just typical sort of factoring kind of a model. But through AI, you're able to go do it faster. And I was talking about the manufacturing supply chain. So I think most of you are pretty familiar with how the value chain works. But you have OEMs where you have Ford, General Motors, Chrysler. Underneath them, you have tier 1 suppliers, and like Magna, like Tenneco. In our case, Denso is so interested in our product that they want to go do a pilot. Denso is one of the world's largest suppliers in automotive. It is an offshoot from Toyota. We're doing a pilot for their sub-suppliers. But below them, you have these tier 2 suppliers, which are basically family-run manufacturing firms. And we help those family-run manufacturing firms work more closely with purchasing. Generally, what you'll find in automotive is the purchasing department wants to qualify more tier 2s and tier 3s, but it's the financial back office that handcuffs them from doing so. If they can't take a net 90, net 120 payment term, they can't work with them. Ironically, if you included more small suppliers, you would drop the price for your parts. But the financial kind of workings or the bureaucracy that's there won't allow that to happen. What we do is we disintermediate that. We go to purchasing and say, hey, we'll help you qualify a lot of these tier 2s in the US and in Mexico. And on top of that, we'll give you an extra 30 days to pay back those suppliers because we're buying the invoice from the sub-supplier. And now you're just paying us back if you introduce us to more tier 2s. So that's part of our go-to-market strategy. And then how are we differentiated from other players in the market, in the fintech space or other spaces? So of course you have banks. Banks will go do credit lines, but as we know, a lot of banks are pulling lines. You also happen to have companies like Marco or Mundi, where they're basically fintech 1.0. You go in, you apply for a trade financing through their platform. They'll basically make a credit decision, but they'll work in several different industries. They work primarily in apparel and agriculture. You also have Zeppelin, which does cash flow visibility and domestic factoring in Mexico and Chile, but not cross-border. And so what we do is we give you cash flow visibility, we're giving you early payment, we're giving you cross-border payment, we're giving you trade assurance. And this is something that's really interesting. In our customer development, when we went to go talk to all those customers that I mentioned previously, a lot of them said, I'd love to know more about the trade history, the contract history of my buyer. And I think we oftentimes think that that's just an exporter issue. That, we just want to go look at what the exporter has. Have they done a lot of contracts? The exporter wants to know if they can trust you. Will you pay them back on time or not? And they're willing to pay 2 to 3% of the trade value for that. we can cover the rest, I guess, maybe in Q&A, but
Let me ask you a question about this slide,
sure.
and then we'll take additional questions.
Sure.
Tell me about this slide.
Sure. So we got our 5-year projections on the left, and then we have our go-to-market. So for our go-to-market, we focus on purchasing power. The purchasing department pain points that are there. So we'll help purchasing as the initiator of a conversation, provide flexible payment terms, and qualify more sub-suppliers.
Nishant, you had a lot of information to convey today. You did this slide really, really well.
Yeah.
Nishant from Alisio, thank you very much. I have to say, you made something that was really complex simple, and then you had a lot of detail that you included with it, which made it real for us.
Sure.
So keep doing what you're doing. I'll leave the questions from Jimmy.
Sure.
And Craig, and Jimmy and Craig.
Is this more of a factoring play than a tech play? And then who's your partner? You guys, you're factoring. Who's your financial partner?
Yeah. So that's what I didn't get a chance to get to. So let me go down on on that side. So
You're as bad as I am.
Yeah. So first off, on the equity side, we're raising $1.5 million. We actually have commitments from 2 Mexican VCs. So one is Alaya Capital, the other is Magma Partners. There are 2 different structures that they've offered. One is $1 million from a U.S.-based fund or angels, and $500 from one of them. The other is both of them together for the $1 million and $500 open to other investors.
That doesn't solve the factoring problem.
But yeah, so then getting in onto the factoring side, on the debt line, we have a debt line committed from Mucker Capital. So that's $1 million line with trigger points to $5 million. That term sheet is already signed. And what's interesting about it is it's a variable advance rate. So you get 95% advance rate on any invoices that are between 1 and 3 from Allianz. Anything that's and that's off the trade counterparty. So let's say that was like Magna. Magna's a 3. You can get 95% advance rate. If it's a distressed supplier, basically from 4 to 6, you get an 82.5% advance rate. Cost of capital is 14% per annum. So SOFR plus 9, more or less.
But when you launch, is there a ceiling on how much you can factor?
So yeah, so let's say that for the first 3 to 5 months, we would be on the $1 million line. So you could do invoices that are $150K roughly to start with. That would obviously ratchet up after that. But the other part about this too is that most of these receivables are like 30 to 60 day. In the lowest cases, but we'd probably look at 90 days. And so the net 90s, you could go and process 4 times within a year, just to give you an example.
Yeah.
And then to go back to the question that you had, which was, is this a fintech play or a factoring play? Yeah. It's a fintech play. It would be similar in a lot of respects what Rocket is doing. If you look at what Rocket does on mortgages, Rocket is the underwriter. They package these mortgages in mass and sell them off to other investors. We would do the same thing, but using AI agents lets you go do that much faster.
But they're not limited to a fund to play with. They have
right. So at scale, right? Yeah. So at scale, in the medium term, you would go switch and get a warehouse line, which is what they're using. So you would go. Let's say you can do $1 million worth or up to $5 million worth. You would then switch to go getting a warehouse line from Bank of New York Mellon or another, large, debt provider like that.
Other questions? Craig?
Jimmy asked exactly the question.
Oh, sure.
You fintech guys, you all.
I got another one though. So you talked about like integration with QuickBooks and all these other tools. Is the goal to replace those tools and be kind of like a core platform, or do you wanna be the AI side of things and factoring and just like link that to other platforms?
I think what you're gonna see over time, and I think we see this with our trust for AI agents, or in general. So first, it's you have a workflow that then goes and flows into the AI agent. As we start trusting that AI agent more, we'll take out more process steps and trust the AI agent with even more. Does that then get to the point where I don't even need QuickBooks anymore just because I got an email in? I'm able to go make my quote and take care of the rest. I think we'll see that within the next 3 to 4 years.
Just in AI agents.
Just in AI agents replacing, not in us, alone. I'm saying in AI agents in general. But it does depend on us as users, and I think manufacturers maybe are a little bit slower than, so we got to meet them where they're at, as instead of forcing it down their throat, right?
So besides factoring,
other revenue sources.
You could do the one or the other, right? You don't have to do all the email scraping and the factoring and the invoicing. You showed the 4 boxes.
That's right. So let me go back up to that slide.
Don't
So
steal the question.
yeah, these agents, and also this maybe gets into like where we are with
Yeah.
product 2. So we've got the Telltale Navigator pretty set. We're raising to build out the other agents that are there.
Yeah.
But what's great about this is that we can meet people where they're at, where you don't have to go and build the entire agent and make it all automated to start out.
Yeah.
You can do parts of the steps that are automated, parts not.
I get that.
Sure.
Just remove factoring. All your tech stack. I'm still trying to understand, even though you give them better data sets and you speed things up, are you really solving the problem of getting them paid faster?
Yes.
Just by, how?
So one would be we're getting you the early payment because we factored it. But the second aspect of what we're doing for you, and I'll go into for the business model side.
You told me how you restructure their financials and all that stuff, but does that really
I'm going back.
get them their money faster?
Yes, because I mean, if off your invoice, I'm getting you the bulk of your invoice paid faster than you would have gotten it if you waited for your sub-supplier to pay you back. That frees up your cash.
But why are they going to pay faster? Just because my data set's better?
No, they're getting it paid faster because you would wait 90 to 120 days for tier 1 supplier to go pay you back. You want that cash faster, so you're going to go in and sell me your invoice.
I said without factoring.
Oh, without factoring. So
Yeah,
now
without factoring, how do you speed up payments without factoring?
you don't.
Oh, you don't?
Yeah,
Okay.
and
I
that
thought you
part
said
we
you did, I'm sorry.
No, that's okay. So I wouldn't. What I would give you though is that on the
That's a super software there, dude. Like I thought you said you could speed up payments without factoring, and you got.
well, that we can do in the sense that like if we talk about real-time payment options or giving you ACH options or things like that, and then in that sense, yes, we obviously are giving you payment tools to go do that. We do that through Currency Cloud. So Currency Cloud is is our back-end payments provider. Anyone else?
I like that way. Jim and then Bill.
My experience is a little dated, but my recollection is that we struggled with receivables in Latin America because of the underlying credit issues.
Mm-hmm.
Our banks would exclude them from our lines of credit. We couldn't use them as collateral for leverage. We couldn't factor them because of collection challenges in those countries, being able to protect your legal rights.
Mm-hmm.
But again, that is a little dated. So are you somehow solving those problems which still exist, or have other larger factoring companies and lenders stepped into that and solved it themselves, and now you're providing a more efficient distribution?
So on that side, we focus primarily on you're a Mexican exporter working with a US buyer. In that situation, you don't need to have a lien or anything else on the exporter. So it's anything that's coming up back to the States. That, of course, from the Mexican supplier's perspective, is freeing up cash that then could be used to go buy inputs. If you think about the inputs, if we did it the reverse, we were saying, oh, okay, this is a U.S. company that's now exporting to Mexico. Can I finance that side of it? That's more difficult to do because of the reasons that you described.
Okay, I apologize for missing a basic point. Will your business model put you in a position to solve the reverse?
You can solve the reverse using what they call it's basically like you can put a lien on the subscriber. You would eventually need to go get a banking license for that. At scale, we could go do that in Mexico, but in the initial phase, we wouldn't. What's that?
Can you bond them?
Yeah, I mean, basically what you would do is like you put them in a trust.
Yeah.
Yeah, exactly. So you could do that, but then like that structure, you need to get a license for in Mexico to do.
Oh, okay.
So that we can do that, and it's not. I mean, we're not opposed to doing that. We would do that at scale because then you're providing services for both on both sides.
Right. You get attached to the cash they're going to get from the States.
Exactly.
Okay, thank you.
Interesting presentation, thank you. I'm having trouble really zeroing in on your target customer.
Sure.
You have the slide talking about Denso, tier 1, tier 2, tier 3, tier 4, talking about customer, you can integrate the QuickBooks. There aren't many tier 1s running QuickBooks. Or
You'd be
tier
surprised.
2s. or who need factoring because they have existing commercial relationships with banks. So tell me who your real target customer, and explain a little bit more about you said Denso's really exciting.
Right.
So
yeah, so I'll answer both with this slide. So
yeah.
Denso's excited because Denso's a tier 1. Denso is extending these net 90, net 120 payment terms, just like Magna, just like others that are out there, to the tier 2s, tier 3s, and tier 4s. They don't really have liquidity issues between the OEM and the tier 1 side. But what they're doing is they're essentially making the tier 2s and below their bank. And so when we talk about why is Denso excited, we're taking this invoice off their books. So when you go look at their Q3, Q4 earnings, they look better. And they would look better for most of these tier 1s. This is one of the reasons why Tenneco, for example, would tell you, at least some people in purchasing, when they were being honest, they would say they wouldn't pay certain non-core sub-suppliers in Q4 because it would make the Q4 earnings look better. Is it ethical? No. Does it happen all the time? For sure. And so, when we talk about credit lines, these are the guys that are suffering, the tier 2s and tier 3s, on maintaining the line. And those are the guys, like when I was talking about SMT automation, they're in this space, tier 2 and below. And then one of the partnerships I didn't get a chance to talk about is we're partnered with Michigan Minority Supplier Development Council. So MMSDC helped secure $583 million in contracts in 2023. They have 2,000 suppliers on their platform. They also are being positioned to be part of the USMCA renegotiations. There's a Chapter 25 of USMCA which talks about small business networks. And so they have, and we're working on extending this with industry clusters in Mexico, also in the US, where smaller suppliers outside of the MMSDC network, and then also with suppliers in Canada. So essentially, can we include more tier 2s, tier 3s, and tier 4s in conversations to work with each other on contracts for tier 1s? That was what NAFTA was supposed to do, what USMCA was supposed to do, and then now hopefully would get delivered on.
All right, Chris Q, one sentence on Michigan Minority Business Council. What does that do for Alisio?
So for us, as Alisio, it's giving us a captive audience to go in and help underwrite contracts with.
Are they a channel partner? Are they bringing you business?
They are bringing us business.
They're a channel partner. Sure.
That's probably my question is on go-to-market. So what's your plan for scale this effectively?
Sure. So we go in through purchasing from the tier 1 side and say, look, we have a supply chain program for your tier 2s, tier 3s, and tier 4s that you're working with. We'll help you qualify more of these tier 2s and tier 3s that are out there. That's one channel. The second is through these associations with MMSDC or industry clusters. You're able to go and acquire a lot of these customers in a more cost-effective manner through this platform. So if you think about, for example, if you have an Amazon platform and I'm providing financing on Amazon when all these interactions are taking place, that's a captive audience. That's essentially what you would have through that type of relationship.
All right, last question, and it's about the data that you are going to collect along the way. Is that licensable? Is that only used to train your AI? Is that an additional asset? As you start to build up a transaction history, you're going to look like, what was that, the big three did a supplier hub, like, what was that called? Covis, thank you. Yeah, you begin to look like Covis.
Right. I mean, over time, if you get the AP and the AR data that's there, you can license it out in an aggregated form to others. But of course, it depends on if the sub-suppliers that are on your network are comfortable with you sharing that in an aggregated, anonymized sort of a
Covis
way.
was all about discomfort.
But yeah, I mean, that's there. The other part that I wanted to mention too is that at scale, you can securitize these invoices and sell them off to the same regional banks that should have been underwriting the credit, but don't want to, in part because of Basel III, Basel IV regulations. You basically have to have more dollars on hand to lend out. They don't want to do that for SMBs, and then even within the SMB sphere, definitely don't want to do it for manufacturers. And so that's the gap that we fill.
There's a VC group in Kalamazoo called Kalamazoo Forward Ventures that invests on a pillar called Equity Gap Ventures that fill an equity gap. The tier 3s and 4s are in an equity gap because they're actually the bank for the tier 1s.
Right.
I'm going to connect you with Kalamazoo Forward. They would get this.
Thanks, I appreciate
that.
But
use the term equity gap. They love that shit. Sean with Alisio. Sing with me. There we go.
All right, two portfolio companies are here today to give us updates on what they're doing with our money and all the cool progress that they've made. And the first one is Kevin Hagedorn with Life Magnetics. Kevin, your 5 minutes begins now.
Thank you. Button thing? Do I get a button thing?
That's your spot.
Oh. Will they put it on the next one?
That's the next slide.
Nope.
They were great.
There you go.
Alrighty then. Exactly, pivot. So we are Life Magnetics, and we stabilize RNA. 10 years ago when I said that, I think that the very first pitch we gave, they said, well, you can't use acronyms. What does RNA stand for? And I said ribonucleic acid. They said, you can't say that either. It's too technical. I said, okay, how am I supposed to present this? Luckily for me, even though my pitch hasn't changed in 10 years, COVID happened, and now the average scientific literacy of the nation increased. So now everybody is familiar with RNA around COVID-19. In the past 2 years, both of the Nobel Prizes were awarded for discoveries related to RNA. This past year, Victor Ambros wrote one of his work, my co-founder, when we got our first NSF award. Peter Cullis won the Upjohn Memorial Lecture at University of Michigan last week. He developed the lipid nanoparticles that encapsulate the RNA in the COVID-19 vaccine. So he's on the board at Biomedical, and he said that currently 30% of clinical trials are RNA therapeutics. It's becoming a larger market. Of course, RNA is a pretty fragile molecule, so in every application related to RNA, transporting and storing RNA is actually a significant issue. For example, another emerging application for it is CAR T therapy and cancer vaccines. Basically, you make a miniature specialized vaccine for the individual person. So you got cancer, your cancer expresses surface marker similar to the spike proteins in COVID-19. You basically make the same vaccine that you did for COVID, but you make an individual dose for that one person. That's how CAR T therapies work. But then you have all the transportation and storage issues like you did with COVID-19 where you had to -80 store it, but now you have to do it with individual dose batches, and it's a lot harder because you have to do quality control checks on each individual batches that you make. So issues like that are a significant impediment to new developments in the field. We also did MedTech Innovator, or one of the sub-programs of that, BioTools Innovator. Diagnostics is generally not the biggest return on investment. The median exit is 30 million. But if you have a tool that you can turn into a therapeutic, that's a better value proposition, because you can start with something that's easier, where you don't have a lot of regulatory approvals, and then show that it works, de-risk the technology, and then if you can then pivot into a therapeutic, then you can get the exit potential of a therapeutic. So one of the largest exits of the last 2 years was a transfection reagent when Sartorius bought PolyPlus for $1 billion, and that's exactly the route that we're trying to go for. We basically have a carbon allotrope, a patented composition of matter, which stabilizes RNA, which is an enhancer for the lipid nanoparticles that you use to deliver RNA therapeutics into cells, which allows for the stable expression of that RNA for a longer period of time. Currently, we're using that for pulling nucleic acids out of milk, basically to prove that it works in a diagnostic application, and we're just about to be profitable in that. We've had good successful round of testing. On the second round of testing, we ran into some issues, but we fixed those. We're going to go back next week, but we're also almost out of money, so we're going to do a very small round, $150,000, to hopefully get us through the rest of the summer and be profitable with our first customer. Our margins on manufacturing of this material are 99.5%. So that means that we can. It's an interesting manufacturing story because we leverage the fiber lasers used in
trying to make a carbon allotrope that you can't make any other way. So we use sort of the existing specialized manufacturing infrastructure around here, which doesn't otherwise exist a lot of other places. And we really want to get this deal closed. We also got a $400,000 grant from the University of Michigan to start developing the transfection reagent. So that is moving along as sort of the next thing that we can do with the technology. But we're really this summer hoping to close a deal with a decent-sized customer that can make us profitable.
Very cool. Thank you, Kevin. That one customer is actually like a bunch of different farms.
Yeah, they service, they're a conglomerate that does milk testing for 7,000 farms in Michigan.
7,000, yeah,
7,000
a bunch.
farms.
Okay, thank you.
And it's a pretty niche industry. They sort of have carved up the U.S. like cable companies. So this is the one that services this area. But they're all sort of in bed with each other, so we hope that closing this one will also mean we sort of rapidly close a bunch of other ones.
According to Spark, you're the rare life science company that's in Lebanon. Thank you, Kevin. And Kevin presented in that very fortuitous November 2023 meeting that we also saw Magsorbeo.
What? Yes. I was going to say, I see them every time.
Yeah. Lucky
So
you guys.
I
Yeah.
don't understand what the problem is with the.
Not just the cycle behind that.
Yeah, great minds thinking alike. Okay, moving right along. Inspired Solutions presented in February
Can I
of
do
20.
one last comment? 2 seconds. So we have 90,000 of the 150 closed. We are looking for 60 more.
That was an important deed. Thank you.
Sorry.
Inspired Solutions, 100% women-owned company that presented to us in February of 2023. And I have to say, Denise and team have been killing it. Here to tell us what that means. Please give us 5 minutes and tell us what you're up to.
Great. Kevin, I thought 50% margin was impressive until.
Kevin turns on his laser and it just
Holy
prints
cow.
money, yeah.
I'm going to move to this side because over there we haven't seen the screen too much. I'm a co-founder, CEO of Enspired Solutions, and what Enspired Solutions has done is commercialized equipment and patented chemistry to destroy the contaminant PFAS in water. So when I saw you last a year ago, we were able to show you a photo of what at that time was our minimum viable product. And since that time, that product was designed and built in Delaware by a company with guidance from a toxicologist and a chemist. Since then, we brought that product back to Michigan, and in-house we went through design for manufacture process. We manufactured it, we commissioned it, we sold it, we delivered it, and we now have our first customer. That customer was willing to pay $625,000 for this piece of equipment, which this is the commercially viable product here, which is a 50% margin for Inspired Solutions. They then had an open house and invited people to come in and see they have a piece of equipment that can actually destroy PFAS. Permafix attended that open house. Permafix came to our office Monday, a couple of days ago, to see the next one we had already built and we're commissioning in our lab. And they are now reviewing contract and proposal to purchase 2 PFASigators. So the market is starting to move on PFAS destruction. We are now being viewed as a superior technology. Independent scientists have actually written this up in scientific publications, mentioning our company name. Another exciting story that's happened over the past year is that Kent County over near Grand Rapids, Michigan has 5 municipal landfills, and all of landfills leach some grotesque fluid that looks kind of like penis and has PFAS in it. So it smells and tastes nothing like this. I can vouch for that. They did a competitive bid process for who could remediate their leachate, and it was very competitive. 15 different teams put in proposals. It was a year-long process. Our team won it. We will be the first permanently installed PFAS destruction unit at a landfill in the United States, in Michigan. I mean, it's in the United States, but I think it's also cool that it's here in Michigan, right? The reason our team won that was specifically stated that it was because of Enspired's participation. The team that we bid with is 4 different companies, and despite my push, destruction with PFASigator was a secondary option within their proposal. And after 2 more rounds of interviews with Kent County, they said, listen, we like your team, we like what you're putting forward, but we will only select your team if you will do it with the PFASigator. They stated they wanted destruction, they wanted it on-site, they wanted it cost-effective, and they wanted it with a piece of equipment that could be portable for them should they choose to move it to other locations. We were the only company, the only team that could provide that. And our technology at the time also had already been validated by Department of Defense. So we have, thank you for especially the women of Pointe Angels who invested. We feel we've been very frugal and done incredible things with your investment. We are now raising a $10 million round to scale what we're doing. The market is moving, we're acknowledged, and yeah, we're ready to hit it. Let's see, help from angels. Help from angels, other than financial, of course. Help, insider value. It's taken us, we've existed, what, 3.5 years now, to really figure out what markets we're going to move first. And now that they're starting to move, to some of you business people, this may be obvious, but it's the ones who can buy our piece of equipment and make money using it. And that has turned out to be what our first buyers are. Specialized waste handling facilities, Taplin was our first buyer, and landfills. Landfills are getting pushed on this because they used to send all their leachate to wastewater treatment plants. Wastewater treatment plants are getting regulated by the states they're in, and they're shutting off the pipe from the landfills. They're saying, we're not taking it anymore. So warm introductions to landfill operators, specialized waste handling can really help us out. We much appreciate it.
Thank you. And now it's time to play. Who wants to be like Scott? Everybody wants to be Scott. Scott last March played Cart Tank. He played Cart Tank so well that he is our Spirit of Pointe Angels Award winner for the month. And how did you do it?
I tried to be average.
That must be hard for you. Don't try to be average. These 6 companies are in this app. You have $1 million each. Go invest. Oh, we used to have cards on tables too.
That works.
Okay. I'm going to find the table cards because they're around here somewhere. So Alisio, Dilemaa, Enspired, Life Magnetics, Magsorbeo, and TreadCycle are the recipients of some or all of your investment dollars. Be like Scott. I'm going to find those cards. Oh, you already did, you're quick, all right. No ad-libs, you have to do your own. No cheating off mom.
Yeah.
Help me out, Kevin. I got a boombox up. Oh, and play Stevie Wonder. Okay. All right, can you tell how excited I am? We have not seen the deal bottle all year. Yeah. It's been a tough drought. But, you know, Lent, Yom Kippur, Ramadan, there's always a break fast. This is our break fast. I would like to invite up the investors in Ivana Health and Curio and my Park Tank winner who doesn't drink Ramadan. We're going to toast you anyway.
Just for tonight.
You don't have to make an exception.
I drink red.
Oh, no. Wait, who's Ivana? You get the whole shot, that's fine.
I think you're thinking of Leonard business.
I am.
Previous
Yes. Oh, and Leonard should be up here because he won Park Tank in March. Ivana, the drug and device. Oh, we are toasting in absentia Ted Mentry and Jim Farner. Jay Farner. All right. Those for our.
There we go.
To the success of your ventures.
Yes, thank you.
Right. May they exit well.
This was cheaper than my other,
Okay, you can bring them on next time. We're done. Thank you very much. This has been a fun hour and a half that took an hour and 45. But please stick around, enjoy the clubby company, and definitely hit up all of the presenters, especially the ones looking at a Q&A, with your burning questions. Don't suffer in silence. Get them answered. We stand adjourned.
All right.